He's global co-head of iShares fixed income ETFs. So at the broader picture here, corporate bonds are something that a lot of our viewers are now investing in because the yield is so good. You're taking on more risk than treasuries, correct? So tell me exactly what goes on in the mind of a corporate bond investor.
Yeah, Liz, so thanks for having me. As you alluded to, there are two flavors. There's investment grade and there's high yield. And so if you get into that high yield tier, you are expecting significant more compensation and spread, right?
Because you're taking on more risk.
Taking on more default risk. So, our investors are looking into both investment grade and high yield. We've actually seen flows into both this year, and I think it's really about just diversifying income. You'll tend to have investors do a little bit of both. It's rare where you have investors all in one bucket, right? So this is how we see people allocating in a multi-sector fashion. So we have seen substantial flows both in IG and in high yield this year.
The economy, when it goes south, you start to see a lot of defaults. The economy is actually pretty stable right now. What kind of default numbers have you seen overall in the high yield world?
I mean, right now you're very low single digits. When you get into these cycles, that can go into high single digits, low double digits. But right now we're still seeing pretty strong fundamentals and cash flow. The spreads are at all-time tights or trending near the tights, and so that's given investors a lot of pause in terms of thinking about value. But if the fundamentals remain strong, then you're basically clipping those coupons, and that's the trend.
Yeah, and bondholders receive fixed interest payments, making corporate bonds more appealing for them. So I get that. Let's turn to treasuries, because again, treasuries yield about the 10-year, I think, is around 4%, 4 point. Let me just see. I had I got it at 4.16 earlier. Now it's at 4.187. So high yield tends to give you more when it comes to clipping that coupon. That said, what a year it has been for overall bond investing. In fact, for the entire industry, we've seen an incredible jump.
Yeah, it's been tremendous. So we've seen record flows across ETFs in particular. So globally this year we saw around 600 odd, 400 alone in the U.S. That's substantially, as an example, in 2024, I think we were at probably low 300s.
442 billion for global bond ETF flows. Year to date, we're at 613 billion. Do you expect to see a repeat of that strength next year?
We do. I think the fundamentals are still intact. And what you're really seeing, people will talk about the 10-year being at 4% or heading to 4.5, back up to 5, back down to 4. What we've seen is investors look past that and simply recognize that the opportunity in yields is better than it's been in 20-odd years. You're going to have these bumps, but we've seen investors relentlessly allocating to fixed income. Why? Because we're at a generational opportunity.
Well, that said, when people are looking to buy just clean treasuries, which part of the yield curve are you recommending? Really
interesting. So we have seen $33 billion go into our 0 to 3 month Treasury bill fund, SGov, this year. At the same time, we've also seen a substantial amount of money go further out the curve into IEF, which is our 7 to 10. So investors are really kind of splitting their bets a little bit. I mean, I think the SGov story is easy to explain. It's investors looking for, a safe harbor, a good, kind of still at a 4% earning that cash return. But we've also seen a lot of flows move further out the curve. We've seen flows into funds like BINC, which is Rick Reeder's multi-sector income fund. So investors are spreading their bets, and I think that's important.
Good to see you, Steve.
Good to see you.
Yeah, BINC has been a huge winner. Unbelievable when you see all of the inflows this year for a new fund. Just amazing performance. Happy holidays.
Happy holidays.
Steve.